There were two people who already submitted homework two, and they got they got it, they got the graded homework four back already. Um, but there was uh, okay. I wanted to address the issues with homework four because it's been um, uh, I've emphasized a lot about how to use two column method, and some people got it right, but some people got it wrong, and some people even don't even understand what two column method is. So I wanted to address that, but uh, well, since there are only two people right now, I would like to give it a couple of more minutes. Let's usually we don't have that many people in the collaborate session, but um, I would like to address this issue with more people in front of more people. So let me give um, let me give like 15 minutes. Okay, so it's 3:06 now. So by 3:20, um, if there aren't more people, I will just go ahead and address that issue. Um, so let me just uh, let me just leave you a while, and we'll reconvene at 3:20. Okay, and hopefully there will be more
Yeah,
people by
Professor.
then. Yeah, yeah. Okay, Sarah. All righty. So let's reconvene at 3:20. Okay. All right. All right, I'm back. I said we would reconvene at 3:20, but I'm back a little early, and I believe there are some people. Um, some people that are still, that are not back yet. So I'll still give another 5 minutes. But so um, let's just let me share my screen and get started. As I said, oh, my connection is poor. Okay. Um, are you all there? Are you there? Let me, because my blackboard says my connection is poor, so I wonder if you can hear me well. Christopher, are you there? Can you hear me, Christopher? Great, great. Maricel, can you hear me?
Yes, I can
Maricel,
hear
thank
you.
you. All right, thank you. I guess okay.
Yeah.
Hi, Stephen.
Hi. What's up,
All
Professor?
right, it seems like my voice is echoing from Stephen's audio, but I would, you know, I can safely assume that you guys can hear me. Yeah, how are you, Sarah? Uh, let me share. Okay, so is this the one? Yeah, and I was some water. So, as I said, there were two people who already submitted um, homework four, and it seems like there's some confusion. I mean, two column method is quite crucial, and I think that um, it will be more uh, critical in homework five. But think about let's talk about what I'm talking about. First of all, so let me go to not there, but type and okay. Um, Now, uh, when it comes to font, right? You can. Um, I've shown this before. If you click this, this is what I call the northwest corner. If you click on the northwest corner, then the entire spreadsheet is highlighted, and then from there you can change the font size and the font face for the entire. There's Georgia. I normally use, let's try Georgia Pro this time. Okay, then the entire spreadsheet is so. Okay, partly it is this, and also okay. Now, actually, this topic is a pricing, right? Markups and markdowns, and overhead. This topic is really the extension of financial statements, especially income statement. Why? Now, think about it. I'll have to draw here. If you remember income statement, right? Basically, it's income statement is all about basically income versus expenses. Isn't that right? Because as long as the income is greater than expenses, you will have profit, right? And they come from two sources, right? First, total revenue, right? And then investment income, right? Second one is investment income. And then expenses, basically, CGS, direct cost, right? Which is also called cost of goods sold, just CGS. And in the homework, a lot of people, I don't know, I've been emphasizing the use of symbols and acronyms because if you spell it out, it takes too much, column width. And if it takes too much column width, then, that simply is against the, that is simply against the compactness or the, conciseness rule. You don't want the verbiage to be, you don't want your model to be too wordy, right? But anyway, the cost of goods sold is, also called total variable cost, and indirect cost, source of indirect cost is operating expenses, right? Operating expenses, which is also called, roughly the same, not exactly the same. Total variable, total fixed cost, okay? And now let's think about it. And we have to subtract, expenses from income, right? Then we arrive at operating income or operating profit. Operating income or operating profit, also called also known as aka EBIT. Okay, or maybe I can, instead of aka, oh, what's happening? Just use equal sign. And then we must, subtract expenses from interest from there, because we owe interest to our lenders. Okay. And then if you subtract interest, it's called, what? Taxable income, right? Okay, I'm not gonna spell it out like that as taxable income, which is also the same thing as earnings before taxes, EBT, right? Because interest is gone right now. And then from there, you will subtract taxes, right? And then you arrive at net profit or net income. Now here, I've been telling you over and over that in accounting, why in accounting do they use these terminologies so loosely and so interchangeably? Remember that? Because from, and that was what I, didn't like about accounting, because why do they keep calling this, income is this state, right? From an economist's perspective, being, you have to use, if income is the term that is applied in gross state, then once it is no longer in gross state, right? After subtracting expenses, this is no longer, gross income. And hence, the name is operating income. Of course, the name changed slightly because, it's called operating income now. But, continuing to use the term income just wasn't very, there was something unsettling about that. Personally, for me, that wasn't quite right to, call it, still continue to, call it. And here also, so I prefer to call it, operating profit and net profit. But again, if you think about, in case of company, in case of a corporation, right, for businesses, we can call that profit. We can call that profit in case of, but if you are not a business, but an individual, as an individual, you have income, you have expenses. Of course, you don't, as an individual, you don't do income statement, you don't keep income statement, but if you, you can still apply the same concept for your own income. So you wouldn't call this operating income because, as a person, as an individual, you didn't, it wasn't a business operation. But anyway, you can still consider that because you, if you worked for as an employee, if you worked for your company, working for your company is your operation, right? Working for that business is your operation. So your paycheck is your revenue because you sold your labor. And then from your investment, savings or investment, there is investment income. So it's the same thing. For expenses, yeah, you can also, it's not cost of goods sold. I mean, but the concept is still the same. There is for you, this is called fixed cost, right? You have fixed cost. You also have variable cost. Fixed cost for you is something like, rent and telecommunications. I mean, most of the times, if you have, you have a plan, you're on a mobile plan, and you pay fixed amount, right? Regardless of, some people may have a different, depending on your data usage, you may pay different. You get the different bill every month, but also commute, it's pretty much fixed, and there could be variable cost. But in your case, as an individual, variable cost is not related to production, but whatever, let's say, you may have a variable cost, one way or the other. So then, you subtract the expenses, and what do you call this? Will you call that, operating profit? No, it's the concept would still be the same, but it would be very awkward. It's gonna be, it sounds awkward if you call your, if you call that profit at the, because you're an individual, you're not a business. So calling it profit is a bit, weird. Hence the same reason, after, if you have interest payment for your loan or things like that, and after paying taxes, it only seems, reasonable to call this net income rather than so that's why I mean, if I were, I'm not accounting, I'm not and I have no reason to speak for accounting, or I have no reason to defend accounting. But if ever, if there's any rationale behind, keep calling behind, continuing to call this income, that's gonna be it, because income is more inclusive or comprehensive concept. I mean, whether it is a business or individual, income can handle both. Okay, so now, but another thing. Suppose, I mean, this is basically, on business level, all these numbers are on business level. Total revenue is, what I'm talking about is on aggregate level, aggregate. So think about it. When you call revenue, we all know, okay, I shouldn't have done that, but rather, we know revenue is price times quantity, right? And quantity means, it's a number greater than 1, right? Quantity means it could include 1, but, if you produce, it could even include 0, or if you produce nothing, right? But you can tell quantity means, also think about it. Total variable cost is what? Per unit production cost also called AVC, average variable cost, times quantity built. This is quantity built and this is quantity sold, right? But you know what that means is we are dealing with aggregate number, aggregate. You understand? Although Q, quantity, means any number greater than 0, right? Quantity means any number greater than 0. I mean, the quantity may be 0. That means the company didn't produce anything, right? It's built. But you know, any part number 1 or so it's an aggregate number that we are dealing with here. But suppose if you produced only 1. Now let's think about, let's think about it in, per unit concept, per unit. Now, in per unit concept, right? If you produced only 1, total revenue is just the price, because it's when you sold only 1 unit, right? When you sold only 1 unit, the revenue is exactly price. So basically, price is what? Price is revenue revenue for just 1 unit sold. Isn't it right? Price is the revenue for just 1 unit sold. Make sense? Everybody's listening? I'm not sure if you, okay, thank you for confirmation. Yeah, prices, actually the revenue when quantity is 1, right? And then, and also think about it, total cost also, okay. And ignore, investment income. Ignore investment income. Now, also, total variable cost is simply average variable cost or per unit production cost, right? Or just let's call it cost. Let's call it, production cost. And then AVC or C. It's maybe I better rewrite it as AVC times 1. Total variable cost is just per unit production cost, when the quantity is 1, right? And TFC can be, of course, total fixed cost can be broken down into. I mean, we can get the per unit total fixed cost, but it's not that simple issue because again, total fixed cost is still there initial input is still there, and total fixed cost is still there whether you produce any unit or 0 unit or 1,000 units. So we'll just leave it as TFC, and we're not gonna we're not going to consider the per unit concept of that just yet. We'll just it's still aggregate, right? Aggregate concept. So I'm not even going to write that. Now the interesting thing is, total fixed cost is operating expenses, right? So should I write this? I think I should still write it. And the total fixed cost we're going to look into. You must have already through the my videos. What the break-even analysis is about. So once we know the break-even, once we know the break-even point, then at least total. That means total fixed cost is recovered at the break-even point. So we can use the break-even quantity, right? That break-even quantity to spread total fixed cost across that quantity so that we can get per unit total fixed cost. But that's not necessary at this point. What I'm trying to say is, this is what they generally call cost, per unit cost per unit. I'll just leave it as C, because P is price, C is cost per unit, P is of course revenue per unit, price is revenue per unit, and then we know this is operating expenses, right? And then so the operating expenses should I have? I don't know. Better use the term. So operating expenses, OPEX. Come on. And we can have interest per unit, right? Think about it. Each unit you sell. So here in the to the right of this dotted line is per unit concept. Per unit concept, right? And to the left of the dotted line, it's aggregate. So this is interest per unit, right? And then this is taxes per unit. So taxes, so think about it. Every unit you sell, right? Every unit you sell has its own contribution, not contribution, what should I say? Has its it has to meet its own per unit obligation, right? Each unit you sell bears its own obligation, per unit obligation to the lenders, right, in interest, and to the government in taxes, right? Makes sense? So I'm gonna interest per unit. I mean, just to make it clear, so that some people because some people just jump into this in the middle of the session, and then not having heard what has been going on, would have no idea why, I'm writing, I'm just, it may, writing it here again in the right-hand side. Now think about it. So we can turn everything into a per unit concept. Even the profit can be, turned into a per unit concept. I mean, if we sold 1,000 units, and then we can divide, revenue by 1,000. We can divide total variable cost by 1,000. We can divide interest by 1,000, taxes by 1,000, and then we can come up with the per unit concept of these things. So now think about it. When they use the term, this is what if you sold only one unit, you sold it at price, so that's price, right? Price is per unit concept always, it's that. And then we have cost per unit concept, cost per unit. And then for the rest of them, operating expenses, interest, taxes is called overhead. Okay. Now the overhead is overhead can be both aggregate concept and a per unit concept. I mean, overhead is generally called overhead. It's the concept that covers it's an aggregate concept, but you understand this is per unit concept. You can divide it by the number of units sold, and we assume quantity sold is equal to quantity produced. Again, assuming an ideal universe, we can make accurate forecast of demand forecast, and so we want there will be no surplus or no shortage. We will exactly produce and sell exact quantity demanded. That's basically ideal universe assumption. But even if it is not ideal universe, even in real world, most of the times the total quantity produced, total quantity built can be all sold. Why? Look, if not at the regular price, right? I mean, you produced 1,000 units of something, and if the demand, but your demand forecast was exaggerated. Let's say you had overblown demand forecast. So then the quantity produced will be will overshoot, right? The quantity sold, and then there will be surplus. If there's surplus, what happens usually? They drop the price. So eventually, it will be all it will be all consumed. It will be all sold. Even there was an example of markdown And then think about it. So we understand what is overhead, right? Price, cost per price is already per unit concept, cost per unit, and then the rest of them is overhead, and then here, it's as I said, profit per unit. This think about it. Profit from selling 1,000 units. If you divide it by 1,000 units, then that's going to be profit per unit. And then, so basically, what the company must decide is over and above cost, right? Why am I keep doing over and above cost, right? Cost is, basically under company's control, right? Cost is basically the variable that the company can control, right? Of course, the input cost is not what the company can control, but um, like labor, capital, raw material. I mean, labor market. If overall wages go up, that's not under company's control. Overall raw material cost goes up. That's not what company can control, but at least the company can shop around for better price, right? I mean, the company can. What is outsourcing? Outsourcing is basically, what company does to, minimize cost. Isn't that right? They're outsourcing even the labor, outsourcing a lot of things, and offshoring, right? Offshoring, uh, you know, finding, offshore manufacturers or offshore suppliers that can supply the parts at a lower cost, right? That's the concept of now. So, but anyway, the thing is, the cost is known to the company because that's one variable that's clearly known to the company. And the next question is, um, think about it. The price must cover cost and overhead and the profit margin. Isn't that right? Isn't that right? The price, I mean, if the price cannot be less than this, the price is the result of this. Isn't that right? So, sum of all of that. So, then what must what the company must determine is this overhead and profit, and this is called markup. Make sense? That's what the markup is. That's what the markup is, right? So obviously, if the markup rate is high, and the markup rate is obviously, then we can determine it by as a percentage of the cost, right? That's why it is called, markup rate based on cost. Okay, markup rate based on cost. In other words, if the cost is, which is this one, right? If the cost is, let's say, $20, right? And then if the markup is another $20, right? Markup is another $20. Then the markup rate is, let's say, $10. The markup rate is $10. And markup is $10. Then the markup rate is the markup rate is 50% based on the cost. Isn't that right? The markup rate based on cost is 50% because it's $10 is 50% of the cost. But then we know then the price will be, what will be the price? Price will be $30. Price will be $30. Isn't that right? But then looking at this markup from the price, from the standpoint of the price, then that's the markup rate based on selling price. Okay, so this must be clearly, distinguished, because if it is based, if the markup rate is seen from the price, then it is 1/3 or 33.33%. Isn't that right? 1/3 is 30, right? The same markup, but based on whether we look at it from the cost, whether we look at it from the selling price, then we have two different markup rates. And think about it. If we then think about it. So how is the price expressed? Price can be expressed then as, okay, I can put it here. Then the price can be expressed as, there is cost, right? And then plus 50% of cost. Isn't it right? 0.5 times cost. So what is this? You can factor out, you got to factor out the common factor. And then it's 1 plus 50%, which is the markup rate based on cost. And I've been telling you over and over, rates, it's a convention, right? It's a academic convention, right? To use, lowercase for rates. Okay. Now, also, if you look at it from the price perspective, right? since $10 is the markup, which is 33%, 33% of, you know, the price. So from the cost is actually, you know, price minus 33%, 0.33 of the price, right? Cost can be expressed this way, but then again, we factor out the common factor. Then cost is P times 1 minus markup rate based on price. Okay, so this is how you find cost. Again, from this, we also, our concern is, what is cost? Well, if you solve that equation for cost, you know, it's simple. It's P over one plus markup rate based on cost. So you might wonder, why do we, can we not just leave it like that? You know, I mean, can we solve it for price? No, no, price is known. I mean, the reason for finding cost, right, unit cost, the reason for finding unit cost is because as a buyer, we don't know the cost, right? As a buyer, we don't know the cost. I told you, cost is what only the cost is what the manufacturers, only the manufacturers know. Isn't that right? Cost is what the seller, only the seller knows, and they don't want to reveal that, right? You understand? Is there any seller or is there any manufacturer that will, you know, openly, right? That will open up their true cost? Huh? You see what I'm saying? iPhone. You want to know what's the true manufacturing cost of iPhone? iPhones are like, you know, iPhone 10, 12, whatever. They are almost, you know, of course, Galaxy, you know, whatever, Z or Fold or whatever, foldable phone or whatever. They're almost like $2,000. You know, but you know, it's got. But if it is cheaper, you would, as a buyer, as a consumer, you would love it if it is cheaper, don't you think? Does everyone agree? I don't know. You know, I can't see. Let me just briefly check. Sarah, your microphone was on a while ago, right? So, do you agree?
I said yes, Professor.
Okay, thank you, because you know I could see your connection was not that good a while ago. Yeah, everyone else. I mean, wouldn't you love it from the buyer's perspective, right? The cheaper the iPhone or cheaper anything, right? Is there anyone who is against that? Is there anyone who wouldn't want it looks like other people disagree. Christopher, you want to pay $2,000 for iPhone? Maricel, do you have no problem paying $2,000 for iPhone? Stephen?
Yes.
So you have Go on, I'm listening.
Sorry, what'd you say?
My question is, don't you agree, if everything is cheaper, I mean, from the buyer's perspective, is there any reason to disagree with that?
Not that I can think of.
Exactly. I mean, as a buyer, if the price of everything is cheaper, then that's something you would like. It's not something you would,
Yeah, of course.
you would disagree with, right?
Yeah, it's
Again,
definitely,
if iPhone 12 is currently, I don't know, is it like $1,500 or whatever? But if iPhone is 12 is only like $500, won't you love it?
of course.
So the whole thing is okay. I think Stephen, your audio is kind of throwing back my own voice. So obviously, if we know what is the true cost of iPhone, production cost of iPhone, we can probably demand, consumers might say, hey, Apple, we know the true manufacturing cost of your, iPhone is only $200. How come you charge like $1,500? Of course, they will, that for anything we can, consumers would have hesitation. Consumers would have hesitation or reservation if we know the true cost, and because everyone will feel that they are being ripped off, right? So that's one reason. That's obviously clear reason why the manufacturers don't want to reveal, any seller wouldn't want to reveal their true cost. And of course, they are entitled to not to reveal. They are entitled to not to disclose, right, their true cost. Is there business, is there trade secret? Is there a trade secret? They don't have to reveal it. But consumers would love it, if they can tell, if they would know. And it's not only the consumer. Who would also want to know? Who would also want to know the true cost? Anybody? Can anybody think of who also wants to know? No one? Come on, guys. Who do you think also wants to know? Don't you think IRS would also want to know what the true cost is? Don't you think IRS would also want to know the true cost of iPhone? Why? Now think about it. If the true cost is, think about it. On the income statement, do you think the companies want to make their expenses look big or small? Are you listening?
Small.
Huh?
No.
Okay, who was that? Who said that? Who said that?
Yes.
Who said small?
It's me, Sarah.
Sarah. Okay, Sarah. Think again. Think again. Of course, look, you might think they wanna, they want, don't, you might think, don't they want to minimize their expenses? Because when the expenses are smaller, right, then their profit will be greater. First of all, if expenses are smaller, right, if this is small, then of course, it cannot be small. When you produce a large quantity, and to have a large income, to have a large revenue, to have a large big revenue, you have to sell a lot. Isn't that right? To sell a lot, you have to build a lot. You have to produce a lot, right? When you produce a lot, this cannot be small. Make sense? For big revenue, you have to have big expenses. But if possible, you want to minimize expenses as much as possible, don't you think? Right? Then, as this gets smaller for the revenue, then this will get bigger, right? EBIT will, if this is, let's say, um, there are two ways. All the companies want to. What's their goal? What's the ultimate goal of any business? What's the ultimate goal of any business?
To make a profit.
Not just to make profit, not just to make profit. Look, is any level of profit acceptable? Any level of profit is okay?
I said just to grow, as long as you're growing business.
What's that?
I said as long as you're a growing business. That's what any business wants to do. They want to grow.
Yeah, but to grow business, right? You need to let's say the company made, a company like Apple last year. Let's say they sold, their revenue was, let's say, let's say $1 billion last year. 1 billion revenue was. Huh? But then,
Okay.
their cost was, 999,999,999. Did they make profit?
They made profit, but they only made $1, so it probably wasn't worth.
Yeah. So is it meaningful?
No.
Any level of profit is meaningful. Is any level of profit meaningful?
Yes and no.
No, because they want to maximize their profit.
Yes, that's the thing. All businesses ultimately their goal is their objective is to maximize profit. Maximum profit is what their goal is. Okay, why? First of all, growing business is a very vague concept, right? Of course, but then how would you make your business grow? How would you grow your business? To grow your business, you have to reinvest. You have to reinvest into your business. Reinvesting means, you are basically plowing back all the profit into the business. And so if you are plowing back the profit, it's better to plow back. It serves the purpose, it's better to plow back the maximum profit than the minimal profit. You understand? Minimal profit, like $1, cannot grow business that much, right? But reinvesting $1 back to business, what? But if your profit was $100 million, that's 10% of that $1 billion revenue, or $200 million, that's 20% of the revenue, and plowing back all that $200 million will do a lot to make the company grow, right? Does that make sense? And not only that, remember, profit is in terms of capital component. What kind of capital component is profit? Do you remember that?
The revenue minus total cost.
Yes, that's the definition of profit. That's the definition of profit, of course. But in terms of capital component, in other words, in terms of nature of capital, what is profit? Do you understand my question?
Yeah.
What does the nature of capital mean? What does the nature of capital mean? Look, does anyone understand? Look, I've been telling you over and over. There are only two types of capital. There are only two kinds of capital, either equity or debt. Isn't it right? That's what the balance sheet is telling you. There are only two kinds of capital, two sources of capital, or two types of capital, either equity or debt. Right? You understand? So think about it. I don't want to go back to the financial statements again. It takes too much time. First of all, when this company started out, when any company starts out, where does the capital come from? To start up a business, you must have capital. You must raise capital. And how do you raise capital? You either have
You get investments.
Okay, my voice is echoing. That means someone has turned on the microphone. So if you have turned on the microphone, why don't you say it?
I said to get investments.
So how do you get investment from?
In order to raise capital, you get investments. You get people to invest in your business.
So how do you get people to invest in your business?
You show them a business plan. You show them why.
No. Yeah.
No or yeah.
That goes without saying. That goes without saying. But then just showing your business plan and etc., and they will all buy your idea. Okay, I'm gonna invest. I'm gonna put like $10 million into your business. Do you think it just works out like that? Of course, you have to convince the potential investors. But then, let's say that is done. Let's say that thing is done. Okay, but who are those investors? In other words, what are the sources of capital? Where does the capital come from? Where does that investment come from? Where does the investment come from? What was my question? My question was, before my question, I said, there are only two sources of capital, two types of capital. And what are those two types of capital?
Debt and equity.
Yes, you got that. Debt and equity are two sources of capital. There are only two sources of capital. In other words, you convince the debt holder, debt providers are whom? Debt providers are the lenders, those who will, loan you money. Then you have debt, right? If they lend you money, right? That's why you have debt. And so debt comes from whom? Debt comes from the lenders or creditors. Who are creditors or lenders? They are either banks or the bond market investors. You sell bond, that's basically borrowing money. Okay? Or equity. Where does the equity come from? Of course, equity holders. But then who are the equity holders? For especially for a startup company, equity is basically what comes from the sale of stocks. So who buys the stock of a startup business? Who buys? First of all, startup business cannot sell stocks in the stock market because they are not accepted in the stock market. You understand? But how they sell the stocks? They are not even known to anybody. They are not known to public. So obviously, so that's why you bring your business plan to the bank, and the bank would decide to lend to you or not. Most of the cases, it's almost difficult, right? Because a bank will not lend to only an idea. You have nothing, right? You have nothing but idea. You have nothing but the business plan, but you don't have anything. You don't have a plant. You don't have. I mean, the reason you are trying to get this capital, raise this capital by convincing investors, is to build a plant, right? To buy equipment that goes into the plant. You understand? The first step, even to take your business to that first step, you need capital. So you take your business plan and try to convince your potential investors, who are either lenders or equity holders. I mean, they are not equity holders yet because you haven't sold. You have to sell stocks to them, and only when after having bought your stocks, then they become equity holders, or shareholders or stockholders. So who are those investors who will give you equity capital? So if at this stage, because you are only a startup business, you don't have any credibility, right? So the only person or the only entity that can invest in you, they will invest in you. The bank won't do that to you. The bank won't lend the money to you. So you would most likely start with zero debt, because nobody will lend to you. But if if anybody buys your idea, it's going to be venture capital. Okay, the venture capital, literally the name venture capital means they are taking a lot of risk, right? They are taking a lot of risk. The risk that a regular bank or a lender wouldn't take, right? The risk is huge, right? So they, if they invest $10 million into your business, this is almost like a totally and purely based on your business plan and your idea. And of course, so venture capital would not make that decision very easily, right? So I'm again, I've been digressing a little, but the idea is, yeah, they want you understand, the prof after subtracting expenses from income, right? Then you'll get, operating profit, and then paying interest and taxes, then you arrive at net profit, which belongs to the shareholders. And I've been telling you, because this is early stage, you're just a startup, you'll be very lucky if you can get a venture capital investing in you. And all of this profit belongs to the venture capital because they are the owners. Okay? You might wonder, what about me? I'm the one who had the idea, blah, blah. Yeah, you are also you're like a partner, right? And you may have a small number of shares because it's your company. Let's say and how much of the initial startup capital did you put in? I mean, if the venture capital invested 10 million and you invested 1 million, right? Let's just to make it simple, venture capital invested 9 million, you invested 1 million. How did you raise 1 million? That must come from you. You may have sold your house, you may have sold, your car, you have sold, whatever you had, barely came up with 1 million. So the total asset is 10 million. I mean, assuming that there is no debt, and if this 10 million is purely, equity, both you and the venture capital are owners, right? But you have, 1/10. You have only 10% ownership because that's 10% share. You have just 10% share in that company. The venture capital has 90% share in your company. Okay, so, but anyway, the profit belongs to the owners, and I've been telling you, what is the goal of all the businesses? What is the goal? Eventually, all the companies, ultimately, their goal is to. What is the ultimate goal? Their goal is to
make profit.
Not just profit.
Maximize profit.
Profit.
Maximize profit. Always the goal is to maximize profit, right? Think about it. So if the profit is maximized, then you plow back in, meaning you reinvest in the company, right? Then that helps the company to grow at a faster rate, or that makes it grow at a bigger rate than at a much greater rate than small profit being reinvested, right? Does that make sense? Another thing, if your profit is maximized, of course, a maximum profit is still a very abstract concept, because what is the maximum? There's a way we can calculate the maximum profit. That's what the microeconomics does. But then, compared to other companies, I mean, if you compare your company to your company's total asset size is only 10 million. If you compare it to a $1 billion company, right? The company whose total asset size is 1 billion. Obviously, there's a huge difference. Size difference is yours is only, a 10, not even 1% of that company. And then obviously the profit generated, revenue would be, much smaller. It would be about 1% of, $1 billion company, right? So obviously, direct comparison is pointless. It's meaningless because a company whose total asset size is 100 times yours would have about 100 times more revenue and about also 100 times more profit than you. Okay, but it's the again, so it's the return on equity that matters, right? If the return on equity on your company, although your company's profit is smaller than the other company, if your return on equity is 20%, but the big company's return on equity is only 10%, your company is more profitable, right? And you will get more investment in your that will induce more investment into your company than the company whose profit return on investment return on equity is stagnating, right? If obviously any investor in their right mind would invest in a company that has 20% return on the equity than the company that has only 5% return on equity, regardless of the size of the company. It's not a factor. So, and I told you, so the reason, I'm talking about this is because my original question was, in terms of nature of capital, what is the profit? And I told you, profit is equity. Why? Equity came from the owners, right? Equity came from the owners of the companies, the shareholders, right? And the profit belongs to the shareholders, right? So it's a capital that belongs to the shareholders. So a profit is equity, okay? But then this is called, internally generated equity. Equity generated from operating activity. Equity generated from operating activity, because this is not injected from outside. Whereas, think about it, the original 9 million, original equity of 9 million that was injected, injected by the venture capital, that was paid in. It's called paid in capital. You understand? Any capital that was that came from outside, shareholders. You might think shareholders are insiders. No, shareholders are outsiders. I mean, in other words, I have Apple shares. I have Apple stock. Am I Apple insider? Huh? I'm not insider. That's what ownership is. Ownership is distributed across millions of shareholders who have no connection whatsoever with that company. You understand? Owner sounds like I'm a partial owner of Apple. I mean, in our example, the original guy, the guy with the idea, who invested 1 million, I told you he's only 10% owner, right? The venture capital is 90% owner. And venture capital can be insider as well as outsider, because look, venture capital has the majority interest, 90% interest. So if venture capital appoints a manager, right, a CEO, you're not necessarily a CEO just because you are the guy with the original idea. You're not necessarily the CEO. I mean, with the approval of the venture capital, you can become the CEO. You understand? Why? Because the owner has the voting right. I mean, think about it. If the venture capital has 90% ownership, then they have 90% of the voting right. You understand? And you have only 10% of the voting right. So, so when shareholders are meeting, that's and sure. In the shareholders meeting, if every shareholder casts their vote, right? The one who has the most the controlling majority, right? The shareholder with the controlling majority will always decide who becomes the CEO. You understand? Of course, no one has no one has supermajority. In other words, no one has 51% ownership. In reality, I mean, it's not even you don't even have 25%. No one single owner has like 25%. But even if you have the majority shareholder will have mostly like 11%, 15%. But then if you can gather friendly forces and vote together, right? So let's say 15% shareholder and 11% shareholder and 9% shareholder or 5% shareholder, they all formed together. They all got together and formed an alliance, and then they control 51%. Those who control 51% can decide anything in their favor. Isn't that right? So think about it.
Yes.
Yeah. So think about it. The venture capital. I mean, whoever. So if the maximum profit is the more profit, the greater profit is. That's capital, the equity generated from operating activity. Otherwise, everything else is, I've been telling you, paid in capital. In other words, when you sold stocks at the beginning to the venture capital, that's paid in capital. And after the company has grown and they went public, right? They went public, meaning they got accepted, they got listed in the stock exchange. So they are selling now their stocks in the market, stock exchange. That's called public offering, right? The first public offering ever is called IPO, initial public offering. So from the public offerings, through the stock market, if they sell their stocks and the capital comes in, that's called paid in capital because it came from outside. And the reason this is a long story, and we simply don't have time. But you should be. But at least I'm trying to give you the structure, the system, the mechanism behind it. And someone with the structural thinking, would easily understand what I'm talking about. So owners are not insiders. You understand? Owners are not insiders. Owners are the outsiders, because owners are usually, those who bought stocks from the stock market. And unless you are something like a majority shareholder has a stake, very critical stake in the company. So if I'm a majority shareholder, I will become one of the directors, because look, there, for Apple, there may be, millions of, maybe, hundreds of thousands of shareholders, maybe not millions, but, hundreds of thousands of shareholders. And there will be shareholders like me, who are just, who have only about, 10 shares. But if I have only 10 shares, that would represent like 0.0000001% of Apple's equity, Apple's ownership. So obviously someone like me someone like me wouldn't have a swing vote. Someone like me wouldn't have any decisive vote, right? I mean, I don't even attend their Apple's general shareholders meeting, because why? I have only 10 shares. To attend their general shareholders meeting, I will have to book a flight to San Jose, California, and book a hotel, and attend the general shareholders meeting, cast my vote, 10 votes, and then fly out again. I mean, just for 10 votes, no, that would be stupid. Unless if you have like 15%, 10% of Apple's ownership, then you would do that. And then again, so there are hundreds of thousands of shareholders, millions of shareholders like this, and then so it's like a representative democracy. In other words, you can vote, but you don't go to the Congress to speak and express your opinion. You understand? You have a vote. You can vote for. You vote in the presidential election. Of course, then it's electoral. Electoral college. That I mean, popular vote doesn't matter, even if that's what happened. Back in. You have to win both. It would be very neat if you win both, popular vote and college, electoral college. Look, the democracy is working through representative system. So it's just like that. Shareholders don't go to the. I mean, I can vote, but that doesn't mean I can go to the Capitol and speak in the Congress or speak in the Senate, right? Because you have to be the congressman or the senator to speak in the political system. So it's just like that. If you are an individual shareholder, but minority shareholder, you don't have a you can vote, but you really don't have much voice. But if I own like but so the shareholders, first of all, they vote their representatives. That's what directors, right? Directors sit on the board of directors, right? That's why it's called board of directors, and directors vote chairperson, right? So chairperson is the representative, head of the ownership, right? So the chairperson then so think about it. If I have like 15% shares, then I can vote for myself. I can run for the director, and I can vote for myself. And most likely, I can sit on the board as a director, right? So think about it. The venture capital will be on the board, and if you can gather all the friendly forces, all the friendly owners, and gather like 51%, you can vote yourself too, I mean, first you would be on the board, and you can run for the chair. You can run for the chair, and you can vote yourself into the the chairmanship. You understand? Because 51%, that's all it takes, right? And then as chairman, what can you do? The whole board will, of course, it's not only the chairman, but if you those who have anyway the largest vote, the greatest share. Um, what does the board of directors do? What does the board of directors do? Do you think the board of directors, run the company? Huh? No, board of directors, that's not the job of the board of directors. Board of directors only, who runs the company? Who runs the company? The management. Management runs the company, right? But then, what does the board of directors do? Board of directors hires the management. You understand? The board of directors hires the management. So that's what the board of directors do. They hire and fire of the management. They can hire CEO, they can hire COO, CFO, CIO, the management, or business professionals. They are experts, right? With Ivy League degrees in business, MBA, or business degrees from Ivy League schools. But then again, if you are the founder, and if you have just like Bill Gates and Steve Jobs, they were both chair and CEO at the same time. Why? Because look, if you can control 51%, so you're the chairman, and you can run for CEO position. And if all the directors agree that nobody can run the company better than the founder, right? And so those who control 51% can appoint the CEO, and that will be approved by the vote, majority vote, supermajority vote, right? Makes sense? Okay. The whole idea is, I digress too much. This is too much time, and I don't know. If you can just instantaneously, if you get the idea, if it clicks right away, I wouldn't have to do this. The point is, so it looks like they want to maximize, because that's the goal. They want, and then if you maximize profit, then you can also bring in more paid-in capital. You understand? There will be more paid-in capital if the profit is maximized, right? So it looks like the company wants to think about it. They want to make this small. They want to minimize. Why? Because there are two ways to maximize profit, right? To maximize profit, there are two ways. One, to maximize profit, there are two ways. One, maximize revenue while keeping total cost constant. Okay, you might second, keeping total revenue constant.
And minimize the total cost.
Minimize cost, yes. Okay, you might wonder, can we not maximize revenue and minimize cost at the same time? No, you can't. Why? First of all, maximizing revenue is something that can happen. I mean, revenue will increase. I mean, if not maximizing, revenue will still increase during the good economy, right? During the good economy, revenue can, during the good economy, because the demand is high, revenue goes up. And during the good economy, not only the revenue, it's not only the revenue. Think about it. The revenue going up is because of what? Increasing sale. Increasing sale means, strong demand. If the demand increases, if the demand is strong, right? Sale, revenue will increase because the sale goes up, right? You understand? But think about it. During the good economy, when demand is strong, what also goes up? What also goes up during the good economy? Huh?
The price.
During the good economy, price goes up too. Exactly. Inflation, right? That also means input cost goes up to input cost. Think about it. During the good economy, right? Price goes up. Why? Because of strong demand, price goes up. But also that means, because of the good business, right? Labor will be in demand, right? Workers will be in demand. So what also goes up? Wage goes up. Wage goes up. Don't you think? Right? The labor force doesn't increase, like that, the labor force doesn't. And you understand, in the US, workers are in short supply. Currently they are in short supply. Huh? During this pandemic, workers are in short supply. So wages are going up. And it's all part of the wages going up also fuels the inflation, right? Because wage is input cost. And since your production is increasing, right? Strong demand, because of strong demand, production is increasing. As production increases, what does that mean? You hire more, not only more labor, you have to hire more material, you have to hire more capital. So basically all input cost goes up. So even keeping the cost constant is a difficult job. You understand? During the time when all prices go up, revenue will go up because of the strong demand, then the best thing you can do is, if possible, right, trying to keep the cost steady. And this can be done in some ways. Why? Because if you wage is determined, not wage is not determined every second, right? Every day it's not like it's fluctuating every day. When you get a job, there's a contract, right? The contract is binding for, let's say, 5 years. So that way, even if the price goes up, the employer can lock into, right? The manufacturers can lock into the constant wage level, right? So wages don't go up until the next contract period. You understand? And if the contract, especially in manufacturing, the contract would be binding for 2 years or for 5 years, mostly about 2 years, I believe. So you can, at least, if you can hold the cost constant, then that's how you would maximize profit. Otherwise, And if the economy is overheating, you cannot grow anymore. Uh, then so total revenue is stagnant because sale hit the plateau, right? Sale has hit the plateau, so revenue is stagnant. Then what do? You'll have to minimize cost. Okay, so that's two ways you can maximize profit. And another thing is, in reality, even during the good economy, even regardless of good economy or bad economy, I mean, this makes sense, during the bad economy because the shareholder, think about it, shareholders will sell your shares if your profit is, if they get, low return on equity, they will sell their shares and the share price companies, value goes down, right? So they try to defend this during the bad economy, right? During the good economy, this is obvious during the good economy, but regardless of good economy or bad economy, uh, they will, even during the good economy, they will try to do this. You understand? During the good economy, this is basically, the behavior of the Wall Street. They want to squeeze as much profit as possible. I mean, MTA all the time. MTA, there's a rate hike. MTA raises, fare hike, and they still, cry out, the MTA, service is not improved. The MTA employees are, uh, their benefit is not, MTA, look, facilities are dilapidating, service quality is bad. Still, they cry out. They are laying off workers. And some stations are becoming unmanned, right? But why? I mean, they still think. The thing is, they still think they are saying, even after this repeated, rate hikes, fare hikes, they still say, we are, under heavy, we are not making money, we're not making profit. That is a lie. Why? Um, because they squeeze, they try to lay off workers, and they do this even during the good economy. They do this. Why? Because the owners of MTA is whom? The majority holders of MTA is the Wall Street, and the Wall Street demands always higher return, on equity. So even despite rate fare hikes, they have to give higher return to the Wall Street. They will have to minimize cost. To minimize cost, what they do, they lay down workers, right? Service quality isn't improving. Subway cars are dilapidated. Stations are dilapidating. But still, so okay, I've been digressing a little. I mean, a lot, not just a little. But the point is, okay. So it's not difficult to understand that the goal is to maximize profit. Then they will have to minimize the expenses, right? They will have to minimize the expenses. But then, so in other words, they want to make. But then think about it. If this goes down, right? If this goes down, what happens to operating income? What happens to the EBIT? Anyone?
Increase.
Yeah, it will go up. Yeah. Who is this? Was it Monique?
Sarah.
Sarah. Okay. Sarah, today I think um you gave me at least like 2, 3 correct answers. I believe, at least two. So, at least two. I haven't marked everything, but at least two that I can remember correct. At least, with certainty. So, yeah, at least you'll get 0.5. Yeah, if this goes down, this will go up. But then, if this goes up, what does that mean? What happens to EBT? If EBIT goes up, what does that mean to EBT?
It will go up also.
Yeah, this will go up too. If this goes up, what happens to taxes? If this goes up, what happens to taxes?
Go up also.
Yeah, this will go up too. Okay? If this goes up, what happens to net profit or EAT? If taxes go up, what happens to this? If tax goes up?
EBTs go up and taxes go up also?
Yes, but what happens to net profit?
Go up.
What happens to EAT?
Go up.
Why does EAT go up? If tax goes up, this will have to go down.
Yeah.
Isn't that right? The more
Yes.
taxes you pay, right? So think about it. Here's the dilemma. They want to. The point is, they want to minimize this. But if they minimize this, all of these things go up, right? All of these things go up, and this will go down. So what do they want to do? Tax will go up. So what do they want to do? Even though this is lower, actually, don't you think they will be enticed, or they will have an incentive? There will be an incentive to make this look bigger. Don't you think there's an incentive for any business to make the expenses look bigger than it really is? You understand?
To lower the tax?
Yeah, to lower taxes. Right? You get it? Not what I'm saying is it's not that they wanna make this big. They just want to make it look bigger than it really is. Okay? It sounds like a tax cheating, right? Sounds like a tax cheating, but there's a certain degree that they allow. There are ways they, two things, through depreciation and, and the inventory valuation. They, it's legit, at least through those two things, through those two channels, depreciation and inventory valuation. They allow, some way of, saving on taxes. Yeah, if this is bigger, then and this will go down, right? If this is bigger, this will go down, this will go down, and also then this will go down, right? Then this will effectively go up. So in other words, here's the thing. All the businesses have incentives, right? Or they have, motives. All the businesses will have motives. They are bound to have motives to save on taxes. So they have motives to make the expenses look bigger than it really is, right? And there isn't much they can do about this, but this can be done by this can go down by inventory valuation method. Inventory valuation method. They can make this look bigger, but this, it's not very clear. I mean, in other words, the companies can make it look smaller, right? So it's not only the buyers who want to know the true cost, but who would also want to, who has a motive? I mean, who has the inevitable reason to know who? How should I say? Who has the most compelling reason to know the true cost of the businesses? Who do you think?
The
Who has the
stockholders?
most compelling reason? Huh?
The stockholders?
No.
The lender?
Stockholders don't care. Stockholders, I mean, it would be good if they know what the true cost. But what did I tell you? Stockholders are outsiders, right? Why would the company reveal their true cost to outsiders? I'm an Apple owner. I'm an Apple stockholder. But would Apple need to, reveal their true cost to me? That's the trade secret, right? It's the insider information, and that insider information is not available to me. You understand? Huh?
Yes.
Stockholders are not all the same. Someone like me, a minority shareholder uh, is a total outsider, right? The majority shareholder who is, on the board of directors, they are insiders, right? And some of them are outsiders still, but they are insiders. In other words, because they can appoint, the management, right? They can appoint the management, and the management reports. Think about it. Management management is hired in that place, right? In that position to work in the best interest, to serve the best interest of the board of directors. You understand? So the board of directors, and if they don't serve the best interest of the board of directors, they'll get fired. I've been telling you, the job of the board of directors, including the chairperson, is to hire and fire the management. You understand? And some of the board of directors are also deep, they can appoint themselves to the top management position, right? If they want to, because if they control the supermajority, if they control the supermajority, then they can, vote themselves into those positions, right? They may have insider information and they want to know, right? That trade secret, but to some outsiders, I'm a shareholder, but I'm an outsider. You understand? So then who has the compelling reason to know what is the true cost? Who would have the compelling reason? No one gets this. This is lack of logical thinking. If you can think logically, right? And if you can think, of course, you got to have also, the systems knowledge. How, think about it. Wouldn't IRS want to know how many are here? Christopher's here, Maricel, Monique, Sarah, Stephen, Jimena.
Yes.
Huh? Yeah. I didn't call your name. I just said, I there are these people, but none of you. There are like 6 people. None of you could think of IRS. Huh? Why would IRS want to know? Now think about it. Because if they have all, I told you, all the businesses have incentives to minimize on taxes. You understand? So they may, and I told you when I said it looks like a tax cheating. Yes, they want, if they don't get caught, they will all cheat on taxes. Okay? Donald Trump cheated on taxes for decades. He's such a villain, but he ran for the president, and some people in this country voted for him. Such a villain. Such a, sneaky businessman, tax fraud. Of course, in popular vote, he lost, but the electoral college, he won. Why? Because electoral college is dominated by the party, and the Republican Party is dominated by the all those business people like Donald Trump, who have all the more incentives to cheat on taxes, right? I mean, that's to save on taxes, but if you save on taxes through a due process, through a legitimate process, then there's nothing wrong. But people like Donald Trump try to cheat no matter what, no matter whatever, no matter how illegitimate or not, they just do whatever that's why they lobby the Congress, they lobby and those Republican senators and congressmen, women, they are lobbied by the you know um, the big businesses, to make to cut on to cut taxes for them. So during Donald Trump administration, about 1.7 trillion or 2.7 trillion, there was a tax cut of like 1.7 trillion or 2.7 trillion for the big corporations and top 1% wealthy, right? And during the Donald Trump administration, IRS was shrunk. A lot of IRS activities were um, put on hold, or defunded, or anyway. You understand? IRS has the compelling reason to know what the true cost is, because if they want to know if they are trying to blow this number up, right? They need to know if they are trying to make this look bigger than it really is. So what was this all about? I mean, why did it look? What is this formula about? You're all trying to find the cost, because cost is not known to the outsider. They want to know what the cost is. And by observing the markup rate, right? Of course, the companies may have, slightly varied markup rates for different products, but, overall, there will be an average number, right? By knowing what the markup rate is, then you can trace it back to true cost. Okay. Now, of course, I'm saying, it's not all for IRS, but, one of the incentives, one of the reasons is to, one of the reasons is to understand the true cost. And if you know the true cost, then you can also get to true cost through inventory valuation. Of course, getting to the cost of goods sold through inventory valuation is or inventory estimation. Inventory estimation. I'm sorry, not inventory valuation. Inventory valuation is a way to actually legitimate the tax reduction. So we're out of time. So I'll have to. This is something that cannot be. It takes a lot of time to discuss this, and it takes a lot of, so this is not something we can do during a regular class, but it's absolutely necessary to understand the reasoning behind all this. In other words, the difference between this course and just the accounting course is that in accounting course, there's no soul searching. You're not searching for the reason behind it. Soul searching is the whole purpose of this course, is the soul searching, right? You got to understand why it's done this way. Why? What's the rationale behind it? In accounting, I'm not an accountant, so I'm not teaching any accounting. But at least in financial accounting, I know in accounting class, there is no understanding of the reasoning behind it. You just do it like mechanically, this is, and then no, that's not, you have to understand the rationale behind it and the reasoning behind it. Okay, so, and this cannot be done in, we just don't have time for this. So that's why this is more like a beefing up of the regular lecture, and it can be only done, aside from the regular lecture. Okay, so we're out of time, so I'm gonna have to call it a day. Don't forget the homework 4 is due tomorrow, so I'll stop recording, and I will see you guys tomorrow. Okay, take care now.
Have a nice day, Professor.
All right, you too. All right.